I guess we're getting started.
Sorry.
Yeah, I try and be as fast as I can when the survey comes out. I try and click that button, stop whatever I'm doing, and make sure I get the information to the name exposure index as fast as possible. I think the thing to keep in mind is most name managers are tactical in nature. The vast majority, are going to be tactical in nature, and almost by definition, you're going to get a lot of trend following, a lot of momentum. So if you look at the recent high up around 100%, the market was at that point had run quite a bit, had about 20% from November into early January. Market had become overbought. Sentiment readings had become extreme. So that's a type of setup where a tactical manager is going to say, hey, it's probably time to go the other way for a while. So we then got some weakness in the market, some momentum sell signals flash, and really not surprised to see that come down a little bit. I would expect it to also pop back up as we're now sitting at all-time highs.
I was thinking the same thing. Yeah, I would expect that to go up a little bit next week. Well, awesome. Well, thank you so much. I know that you have a presentation that we can kind of run through, and I believe in the beginning there, you want to give a little bit more of a background to Heritage Capital. So I'm going to pass over the presentation to you.
Just real quick commercial about Heritage. We focus on outsourced investment management strategies for advisory firms. I don't work with individual investors. I work with registered investment advisory firms. We offer outsourced CIO services, white label portfolio design, which means we'll design stuff customized for our clients. We provide portfolio signals, then we also provide sub-advisory ongoing day-to-day portfolio management. We work with our clients in 3 different ways, either as a consultant, a signal provider, or as a sub-advisor. So enough about the commercial. Ben, you mentioned that you like to, in these name confidentials, you like to talk about people's quotes. Should I get into some of those?
Oh yeah, no, I'm excited. I'm excited to hear which one, because I had a brief intro to this the other day on which one you came up with yourself.
Well, the funny thing is I don't remember coming up with it. But anyway, my first one is, it's not about being right, it's about making money. And this was originally, it's actually the title of a book by Ned Davis of Ned Davis Research. I like to say it's really not about being right, it's about getting it right. So many people in our business, spend their time, writing, going on TV and stuff like this, and talk about trying to be right, to get it, make that big market call about so that they can look right and brag about how right they were. But really, in my experience, and I've been doing this a very long time, it's not about being right. It's about, it's about making your returns go up. So one of the problems with trying to be right is you may be early. And it doesn't really matter though. Like I actually have a new client coming on board, and the reason they're coming on board is they are a macro or a global macro strategy investor, and they have been negative. They were part of the recession camp, and they were calling for a recession, in the U.S. And so they were just dead wrong last year. They may eventually be proven right, but early doesn't equal right in our business. You have to get it right. So it's not about being right. It's about making money for your accounts and getting it right in your strategies. The next one, I've always loved this, and when I was Googling my favorite quotes, and I put into Google who said do nothing, absolutely nothing until there's something to do, and apparently I did, Ben. So if you Google that, you come up with one of the firms I work for on their blog. So do nothing, absolutely nothing until there's something to do is a big reminder that I try to have for myself. I think it is very easy in our business, especially those money managers in the crowd. It's very easy in our business to think you need to be doing something. I have literally had clients say, well, Dave, we can't just sit there in the market for a year and a half while the market's going up. And my response is, why not? That's the right thing to do. If you try and short during a bull market, you're likely to get singed a bit. So this is just one of my favorite sayings to try and remind me that, you've got to stay on the right side of the market's primary trend. That is my goal. That is my job. So this saying, do nothing, absolutely nothing, Dave, until there's something to do, means that it's okay to ride the trend. It's okay to stay with it. For example, last fall, remember that pullback we had? It was actually last summer coming into November. It went a lot farther than anybody thought. It lasted a lot longer than anybody thought, but my indicators were still telling me it's a bull market. It's just price has gone down a little bit. So I'm pleased to say that I didn't do anything, because I felt that the background environment nothing had really changed. So do nothing, absolutely nothing, until there's something to do. And then finally, you can really put any word, any descriptor in place of valuations here, but a lot of analysts, and especially those that tend to be bearish fairly often, like to point to valuations as a reason to be negative, as a reason why stocks can't go up any higher. And as someone who lived through the 90s and then the 2000s, I've learned that valuations really don't matter. They're a lousy timing tool. They don't really matter at all until they do. And it's when they do that they matter a lot. So, for example, right now, I think we can all agree that stock market, valuations are fairly rich. They're stretched. Some will even say extreme. You can pick. There's hundreds of these indicators. You can find some that are really negative. And the bears are saying, hey, well, valuations are too high, can't go any higher. The response, though, is that this market is focusing on a couple different things. It's focusing on the economy, it's focusing on earnings, and it's focusing on the Fed. And we all know that when the Fed cuts rates for the first time, the market tends to go up for the next year, anywhere from 15 to 24% on average. So the market lately has been focusing on, the Fed expectations. The Fed's going to cut rates, markets tend to go up, and this is a no-brainer. It happens like 90, 100% of the time. So at this point, valuations really don't matter. They are high, but they are not the 1999, 2000 high. Yes, AI may be getting a little over exuberant, but this also may be the beginning innings of a game that lasts many years. So right now, valuations don't matter. However, if the economy were to weaken, or a company like, say, NVIDIA were to come out and say, yeah, business isn't going so great, that would be a game changer. That's when valuations might matter. Valuations also might matter if inflation suddenly gets stickier than it's expected to do. Remember, part of that inflation formula has been stickier than expected. A little uncomfortable last month and with those January CPI, PPI numbers, but we kind of knew that. So if we get a surprise and tells us that inflation is too high and the Fed can't cut rates, then valuations might matter. So this brings me to the concept of how I've managed money throughout my career, and one of the best pieces of advice I can give advisors is to trust yourself, find your process, find what you believe in, and do that. So I've found, lots of people in NAAIM like to be, totally quantitative. Don't let any decisions come in. Don't have any subjectivity or discretion. I can't do that. I am not a pure quant. I can't be, because I've been around long enough that I know that things occur that have never happened before, like, COVID. We've never shut down the economy before. So there was not, and then open it back up 3 months later on a dime. So there was no model for that type of environment. So if you're a quant, then you just have to say, well, the 30% declined, and then the big rebound, we'll get it next time. So I believe that as a rules-based investor, my approach is based on rules. If this, then I should be doing that. But at the same time, if COVID comes along, I got to use my head a little bit and say, okay, what the heck is going on? We've got to throw the historical analogs out the window. So I am mostly rules guided, And then occasionally I will, my experience comes in to help me make decisions specifically on timing. So if I get a buy signal in portfolios that I'm responsible for and I have to put the money to work, I may wait for the market to pull back a little bit or something like that. So that's what I call being a rules guided manager. The next big thing that I do with my business is I believe in what I call a modernized approach to portfolio design or diversification. We'll get to that. I'll explain that a little bit more in a second. But basically, markets move at the speed of light, and MPT has not really done the job in terms of managing risk for clients over the years. The other thing, the next really part of my process or philosophy that I think is probably fits with everybody who's ever watched this is managing risk is mission critical. I like to say, Mr. Client, would it be okay if we at least try to lose less the next time the market goes down 30, 40, 50%? We probably won't get it perfect. In fact, I can almost promise you we won't get it perfect. But how about if we just try not to lose 40%? If we lose 20, okay, 20 is a lot better than 40. And I think we all know the math associated with that. And then finally, part of the process that I think is really, really important is to know yourself and trust your own process. It takes a while to be able to ignore, most of the people on TV. It takes a while to hashtag on mute. Everybody wants to, well, so-and-so said this and Goldman said that and Jamie Dimon said this, just turn it all off. Understand what you believe in and manage money that way. And we'll get to more of that in just a second.
If we go back to that, I do have a few questions on the previous one.
Sure.
So the knowing, let's see, so the rules guided manager. So what percentage of the time do you, I guess, kind of have like your own personal take on the signal and not necessarily go with where the strategy is saying? Do you have like a rough estimate on that?
No, and let me clarify. I'm probably never going to just ignore a signal. It's a matter of when I implement it or how aggressively I implement it. So, for example, if a signal comes along, let's use today. We closed today at an all-time high. Let's say over the weekend I run all my models and the timing signal comes back and says, well, you should be leveraged long now. I might say, yeah, that's great. We're at all-time highs. You were overbought, sentiment's extreme. Maybe we just chill on that for a week or two because I'm already fully invested. I'm already invested in the stuff that's working. So that's kind of more the stuff that I'm talking about.
That clarifies that a lot. That makes a lot of sense. And then know yourself, trust the process. When you were talking about the media, I think at the last NAAIM Uncommon Knowledge seminar that we had, there was actually a speaker on like teaching your clients, and I think they were looking more at retail clients to kind of ignore the noise out in the media. So that was just ringing in the back of my mind, which then made me think, are you going to NAAIM this year?
Yes, I am.
Did the Uncommon Knowledge? Yes.
Yes.
Yeah.
Funny
those are a lot
story
of
around
fun.
that. Funny story around that. I originally was, and then my wife, she's the travel queen, and she was asking me, well, when can we go to the UK? And I said, well, and I was doing something else. I said, well, the UK is these dates. And then, an hour later, she told me, okay, I booked the flights to the UK, not Uncommon Knowledge, the UK, as in England. So we since got those rearranged, and I will be able to make it to the conference. Really looking forward to it.
Yeah, the conference, so it's April 28th through May 1st, and it's in Orlando, Florida, not the UK. Maybe one day, but not yet. It would be kind of cool to have a UK though.
It would be great.
Well, perfect. Yeah, thanks for asking those questions. Yeah, and let's see. I think I was kind of cut in the middle of your presentation there, so we can continue what's going on.
And feel free if you've got something you'd rather talk about. I'm happy to just chat. Some people, my partner Jeff Peach often gives me a load of what about this concept of a modern approach to portfolio design, and I think the point is, markets changed in the mid 2000s, specifically 2011. Things really started to change, and this is when high-speed trading took over. This is when algorithmic trading took over, and so we had these crises. We had 2008 and on and on and on. And what we found was that MPT really, the classic diversification by asset class, by region, by style, et cetera, really didn't do much to help protect investors, because during times of crises, what happens is that the correlations among asset classes go to 1. There are basically 2 types of assets. There's government bonds, which tend to do well during a time of crisis, and then everything else that tends to act like the S&P 500 and follow the U.S. stock market. So having a traditional MPT approach really failed, in my humble opinion. So the question is, how do how as investment managers do we protect our clients and our businesses, for that matter, when markets move at the speed of light and the traditional stuff really hasn't worked? So, I spent an awful lot of time at NAAIM conferences and then on the phone talking to my friends in the industry, long discussions, usually at a bar, right? And we talk about, these problems, and what we came up with, how do we answer this? There is no perfect answer, but what we came up with was the answer of the solution is good old-fashioned diversification, but done in what I'm going to call a more modern, or just a different way. So instead of diversifying just by asset class or just by region or style box or something like that, we want to diversify portfolios by investing methodology, by strategy, by manager, and also by time frame. And this to me is a modernized approach to diversification. So what do we mean by that, real quick? These are the primary methodologies of investing: passive, strategic, tactical, selection, which meaning stock or bond picking, and then alternatives. The problem is that there's a time. There are times when tactical, for example, has been the only way to go. Think 2008, think 1987. Bear market type things. And then there's times when tactical doesn't do very well, which are usually long, straight up bull markets. Just when passive is really the methodology that's in favor. The real problem is you can't know in advance when a specific methodology is going to come out of its funk and begin to lead, or whether it's done leading and is about to roll over. So what do? In our humble opinion, you diversify. You use some passive, name members who think you have to have all your money in tactical. But yeah, I think you can have some passive, think muni bonds. Muni bonds are a nice little slug for a portfolio. You can have strategic allocation in a portfolio, which is just tactical toned down quite a degree. You can have tactical allocation. You can pick stocks, and you can have alternatives. So that to me is, the basis of modern diversification. Then once within each strategy, diversifying by those strategies makes a lot of sense. So for example, let's use the tactical methodology. So I think we all know that pretty well. Within tactical, there's various strategies. There's trend following, there's mean reversion, there's rotation or relative strength, things like that. And we could probably list 20 different strategies of tactical approaches. The problem is that not all of them work well together. Some of them butt heads. So diversifying so that you don't wind up with 8 trend following strategies in a person's portfolio, to me, makes sense. So if you're a trend and momentum guy, which I tend to be, the majority of my strategy is going to be trend and momentum oriented. But I also would like to add a little mean reversion in there, because darn well, when things get too hot, we tend to get a mean reversion move and a pullback. So if I can feather that long exposure at the top when my mean reversion indicators are screaming at me, so you take a little off, you wait for the mean reversion indicators to go the way, then you put it back on. That's called trading around a position. So you start by employing multiple methodologies. Then within each of the methodologies, you want to diversify your strategy. And then finally, you want to diversify by manager or research provider. I think it's important to recognize all of us managers, everybody in the business, we have our own bias. I can tell you mine. I believe in risk management, and the trend is your friend. Those are the 2 biggest for me. So if you're going to truly diversify, you're going to have to bring something into a portfolio that you may not agree with. So recently, Jeff and I were interviewing a manager, and we got done, and we got on the phone with each other, and I said, I really hate that. I don't like that at all. And I said, that's probably why we should get on the phone and sign this guy up right now, because I think it's since I don't agree with it, it probably makes sense as a good diversifier. So the key is, if you use a single manager's bias for 100% of the portfolio, you're probably going to get the same concept over and over and over again, which is what I call 8 buckets of white paint. And the bottom line is, for investors or strategists or advisors, the key is, don't put all your eggs in any single investing basket. And that, again, is the thing. I don't believe in trying to hit home runs. We believe in trying to hit singles, doubles, trying to outperform markets. On the way up, you want to outperform by selection, maybe leverage. I mean, again, there's 3 drivers of alpha, right? Timing, selection, and leverage. When you buy and sell, what you buy and sell, and how much you buy and sell. So different approaches. Wouldn't put all of my eggs in any basket. And so this diversification by methodology, by strategy, by manager and research provider, and also by time frame, is really my feeling on what a modern diversified approach really is.
Do you have a set number of managers or different approaches that tends to be more of a golden number, or is it different for every single kind of cumulative strategy that you're trying to design? Like, have you found that, like, okay, I want to have 2 or 3 managers? No, I want to have 5 or 6 different managers in this investment philosophy.
No, there is no specific number. It really depends on, remember, my clients are investment advisors. So my job is not to tell the investment advisor how they should run their business or how they should run their book. Okay. Their strategies have to be developed around their view of the world. So they may believe that alternatives are the cat's pajamas. So if in that situation, we're going to want to have more alternatives than another person who tends to be risk management oriented or trend following oriented. And it also depends totally, Ben, on the size of the portfolio. Like I was asked to manage money for a family office, very large family office. And, when you've got $250 million to work with, you can use 7 or 8 different managers, and you can increase that diversification. If you're dealing with $100,000 portfolios, then you're probably going to be limited to the number of managers you can use. I don't think it's important to use a set number of managers. The idea is to just make sure that everything doesn't come from my brain, so that there's something else in there that so that when inevitably I'll get it wrong at some point, right? And we don't want to take the whole thing down because I was wrong. So I hope that makes sense.
Yeah. So one more follow up to that. Then how many different philosophies then do you guys work with? How many different managers do you have out there?
We probably have a stable right now of 7, 8 different managers, and those 7 or 8 different managers have about 100 different strategies that we have access to. So what we try and do, for example, in the funds, we use multiple strategies and multiple managers, and we try and keep, the trick is to figure out if a manager is just going through a funk, and if they're just going through a funk, or the market doesn't favor what they're doing, that's fine. Performance isn't the absolute arbiter. So if a manager has a strong record and doing pretty well, and maybe is having a struggling right now, we're not going to take them out. We're going to leave them in there and let them do their thing. Again, I hope that makes sense.
No, that does. Thank you.
Oh, real quick, I think we can all agree managing risk is mission critical. I love it when people say, well, why do I want to do that? Why not just buy and hold? And then I get into how about if we just try to lose less the next time the market goes down? How about instead of losing 40%, we try and lose 15? Is that okay? And people are like, yeah, that'd be great. So instead of selling people on why you want to do this, just asking that type of question, I found to be really successful. What I've learned over my career, as time has gone on, time periods have become more and more compressed. High speed trading takes over, algorithms take over. And, when I started the business, short term was considered 7 to 10 days. Now, short term is lunch. Intermediate term used to be 3 months. Now it's more like 2 or 3 weeks. So as everything gets compressed, strategies have gone in and out of favor. So for me, what I've done is I've become more and more long-term oriented. Instead of trying to get the next 3 to 5% right in the market, which is really, really hard to do, I'm trying to get the primary cycle right. I'm trying to stay in tune with whichever animal is in charge. So if we're in a bull market, I want to lean long. I want to give the bulls the benefit of the doubt. We'll try and trade around. We'll try and manage some risk during corrections, but we're primarily going to try and stay in tune with that bull market. Then when you get to a bear market, we want to lose the least amount possible. I stole this from somebody. I don't remember who it was, but I love what they said. They said, if we look at the next 5 bear markets, we'll probably get 3 of them right. Understand that every bear market is different. So we'll probably get 3 out of 5 right. We're probably going to botch one of them, and maybe we'll muddle through on one of them. And I think that really is a great way to set expectations. And so if you're not using that type of information or that type of messaging with clients, I think that's a really great way to determine. Because this last bear market, the NASDAQ 100 was the leader. NASDAQ 100 went down 45%, but the S&P 500 only went down 25%. So if you're a relative strength or momentum investor, you were invested in the NASDAQ 100. So it was really hard to lose less than the S&P 500 when what you were in lost 45%. I hope that makes sense. But so the goal is to lose the least amount possible, and I personally I feel much more comfortable focusing on the primary cycle of the markets. So real quick, my last comment, I know we're running out of time, but the best advice I can provide to money managers are the following. Number 1, stop listening to everybody. Turn the TV off. You can leave it on, just put it on mute. Create what I call your inner circle. If I have Bloomberg or CNBC on TV and I see a certain someone come up on TV, I will unmute it and listen to them. But it's probably 3 people. Because I don't need everybody's input, because I have a certain way of approaching the markets. I have a certain way of doing things, and I don't need everybody's opinion. So create your own inner circle of people you like to hear what they say, and then kind of tune everybody else out. Next, trust your process. Your process will struggle at times. I can promise that. And that's when it's really hard. One of the hardest things for us to say as managers is the following. What I do isn't working very well right now, but that's okay, because everybody has their time when they do well, and all managers have their time in the barrel where they really don't do that well. So understand that, and life will be a lot easier. And then finally, the probably the most important advice is to stay flexible and be able to adapt to changing environments. I don't allow the word should, could, or would in my firm. I never have. It's about getting it right. It's okay to be wrong. What's that saying? It's okay to be wrong. Just don't stay long for wrong. So flexibility is really the key, and having the ability to adapt to various environments, I think, is really the cat's pajamas, and really, really important to staying in this business a long time. So that's it for me, Ben.
No, I like that a lot. And that's that best advice, especially I think there's a lot of NAAIM members who will watch this either now or later on, and they've learned some of those things just by being in NAAIM. I mean, your inner circle can even start with some NAAIM members too. You can get some.
Absolutely.
Yeah. So
I listen to Paul. I don't trust him all the time, but I certainly listen.
Oh yeah, no, that was really good. I mean, I had a few questions there, but I enjoyed just kind of listening to all the knowledge that you had, that you just presented there. And I think at the end, if anybody wanted to get in contact with you, how could they reach you?
I have another slide. There we go.
Boom. Well, perfect. There it is.
Yeah, there's a contact us on the Heritage page. Feel free, or email me, or Susan knows my phone number. Ben, you know my phone number.
Yes, and then I think I'd mentioned like the state of the markets that you do as well. Is that available through there?
Absolutely.
Yes.
Yeah.
Okay.
I'm writing less than I used to. Getting a little older. Been doing it since the 90s, so I try and write once a week, every other week, something like that. And really, what I'm trying to do right now is only write when I have something important to say. But yeah, I try and stay in tune with the market drivers, and I think that's the really important these days, is to what's driving the market, and right or wrong, whether I believe it's correct or whether it's stupid. You have to understand what is driving the markets. And right now, AI enthusiasm is driving the markets.
Awesome. Yeah, no, thank you so much. Well, yeah, thanks again for coming on here. I believe next Friday, Brandon is doing another presentation. If I saw on the schedule, we have John McClure speaking. So
Excellent.
see everybody next week. And once again, thank you, Dave.
Thanks for having me.